In this video, we're going to build an advanced smart money trading framework step by step. You'll learn how to identify high probability flip patterns, align them with higher time frame supply and demand zones, and apply advanced entry models such as mitigation blocks and breaker blocks to pinpoint precise trade entries. By combining higher time frame context, market structure, and advanced execution techniques, you'll develop a complete framework for identifying major market reversals and executing high-probability trading opportunities with greater precision and confidence. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now let's begin. In a bullish scenario, the framework begins when price flips the most recent demand zone immediately after interacting with a higher time frame area of interest. Price then retraces back into the newly formed flip zone, which now functions as a supply area. From there, price often reverses aggressively, moving against the previous trend and confirming a potential shift in market direction. In a bearish scenario, the setup develops when price flips the latest supply zone immediately after rejecting a higher time frame area of interest. Price then pulls back into the flip zone, signaling a possible transition from bullish momentum to bearish pressure. Of course, the process is not quite as simple as it sounds. Several important conditions must be met before this setup becomes valid. So, let's make everything clear with a practical chart example. In a bullish market environment, imagine that price originates from a higher time frame demand zone. This tells us that demand remains firmly in control of the market. The first step is to determine the overall market direction by identifying the breaks of structure and the demand zones associated with each impulsive leg. Every time price breaks a previous high, it creates a new unmitigated demand zone at the origin of that bullish expansion. As we can see, price is clearly trending higher. Multiple bullish breaks of structure have already formed, along with the demand zones linked to each impulsive move. The next thing we want to see is price reaching a higher time frame point of interest, such as an unmitigated supply zone or an unfilled fair value gap, and showing clear signs of rejection. Once that happens, price shifts direction and begins retracing until it reaches the most recent demand zone on the current time frame. Price then tests that area, produces a minor bullish reaction, and immediately breaks through it with a strong bearish displacement move. This sequence confirms that supply is regaining control of the market and signals a potential shift in direction. At this stage, we have a flip zone positioned within premium, creating an ideal selling opportunity if price retraces back into it. This may seem a little complex at first, but there is no need to rush. Take your time. We are going to break everything down into simple, actionable steps and cover every rule and requirement needed for a valid setup. Before we dive into those details, let's quickly review what flip zones are and how to identify them correctly. A flip occurs when price shows a minor reaction from a key supply or demand zone and is then immediately broken. It is a powerful reversal pattern that signals a likely shift in market sentiment and direction. Flip entries are one of the most effective ways to enter a trade early while the market is rapidly moving lower or higher. In a bearish example, the psychology behind a flip is straightforward. Price is in an uptrend, demand remains in control, and the expectation is for higher prices. But then, the narrative changes completely. The most recent demand zone fails to generate enough buying pressure to create new highs. It weakens, loses influence, and is eventually broken. That break tells us that supply has regained control, and from that point forward, our focus should shift towards selling opportunities. As a result, the last bullish candle, or cluster of bullish candles, at the origin of the bearish flip becomes the flip zone. Simply put, those bullish candles inside the reaction phase define an area where we should look for short opportunities if price returns. In the same way, a bullish flip zone forms when price reacts from the most recent supply zone and immediately breaks above it. In that case, the final bearish candle, or group of bearish candles, at the origin of the bullish flip move creates the flip zone. At this point, you may be wondering what separates a change of character from a flip. Flips are similar to change of character patterns because both represent potential reversals. However, there is one important distinction. Every flip is a change of character, but not every change of character is a flip. When a flip forms, price often reverses much more aggressively, giving it a stronger edge than a standard change of character. Flip patterns are also more mechanical, rule-based, and easier to execute because they provide a precise entry area while simultaneously signaling a potential shift in direction. However, not every flip should be considered valid. For a flip to qualify, price must first mitigate and reject a higher time frame key zone. This rejection is what shifts market sentiment and creates the conditions for a genuine directional reversal. If price forms a flip pattern without first mitigating a higher time frame supply or demand zone, the move is often nothing more than inducement, a liquidity grab, or a standard retracement, rather than a true shift in direction. Setups like these should not be treated as valid flips. Flip patterns become even more powerful when a clear inefficiency is created during the flip process. When that happens, price is far more likely to revisit and mitigate the flip zone. To trade this strategy effectively, you should use 3 different time frames. A higher time frame for identifying unmitigated areas of interest, such as supply and demand zones. A main time frame for evaluating market conditions and locating flip patterns, and an entry time frame for identifying confirmations and execution opportunities. This is where your actual trade entry will take place. These are the combinations I personally recommend. The 4-hour chart as the higher time frame, the 15-minute chart as the main time frame, and the 1-minute chart as the entry time frame. Another option is the 1-hour chart as the higher time frame, the 5-minute chart as the main time frame, and the 1-minute chart as the entry time frame. Of course, you can experiment with other combinations as well, but always backtest them thoroughly before applying them in live markets. In a bullish scenario, the first step is to analyze the higher time frame market structure and identify the nearest unmitigated demand zone that price is likely to reach. Once price taps into that higher time frame area of interest and shows rejection, the setup begins to take shape. Next, move down to the main time frame and wait for price to retrace upward into the most recent supply zone on that time frame. After a brief reaction to the downside, price should immediately break above the zone. In other words, it should flip the most recent supply area. From there, trace the move back to the origin of the bullish expansion and locate the reaction phase that triggered the breakout. That origin becomes the flip zone. This flip signals that the temporary bearish retracement is likely ending and that bullish momentum is beginning to return. At this point, we expect price to realign with the higher time frame trend. The next step is to mark the flip zone on the main time frame and wait for price to revisit it. Once price returns to the flip zone, move down to a lower time frame and monitor closely for confirmation signals such as V-shaped recovery patterns or a clear market structure shift. At this stage, we have 2 different approaches for entering a long position, each with its own advantages: the mitigation block and the breaker block. In the first entry model, once price taps into the main time frame flip zone, the formation of a mitigation block on the lower time frame provides a strong opportunity to enter long. For a bullish mitigation block to form, price must first create a swing low, then a swing high, followed by a higher low. After that, we need to see a market structure shift confirmed by a bullish displacement move that closes above the swing high. In this case, the bullish mitigation block is defined by the bullish candle, or cluster of bullish candles, formed between that initial swing low and the first swing high. To execute the trade, place a limit order at the highest point of the mitigation block and wait for price to return and activate it. For take profit, you can target the nearest liquidity pool on the current time frame, or aim for a higher time frame objective if you are looking for a larger move. Keep in mind that a breaker block differs from a mitigation block, because with a breaker block, we look for a lower low rather than a higher low. In the second entry model, we wait for a bullish breaker block to form inside the main time frame flip zone. For a valid breaker block, price must first create a swing low, then a swing high, followed by a lower low. After that, we need to see an immediate expansion move in the opposite direction that creates a market structure shift. In this scenario, the bullish candle or group of bullish candles located between the first swing low and the swing high defines the breaker block area. This is the zone we use to enter a long position. Naturally, the exact same principles apply to bearish setups, only in reverse. Now that we have covered all the rules, details, and requirements needed to apply this strategy correctly, let's walk through a real chart example to reinforce everything we have learned so far. Here we have the euro against the US dollar on the 4-hour chart. As you can see, price is in a strong downtrend, and sellers are clearly in control. The most recent bearish break of structure is located here, and at the origin of that move, we can identify an unmitigated supply zone. I'm going to mark this bullish candle as my supply area. This gives us a fresh and clean supply zone, exactly the type of area we want to focus on when looking for short opportunities. If price retraces into it, the next step is to switch to the main time frame, which in this example is the 15-minute chart, allowing us to get a clearer view of the price action while waiting for price to revisit the 4-hour supply zone. Now let's continue unfolding the chart and see what happens next. On the 15-minute chart, you can see that after reaching the higher time frame supply zone, price reversed and formed a clear VSR, a classic V-shaped recovery pattern. If you mark the bullish break of structure levels, you will notice that price created several consecutive demand zones as it advanced into the 4-hour supply area. In addition, after tapping the higher time frame supply, price retraced lower, and following a small reaction, flipped the most recent demand zone by breaking and closing below it. At this point, price is expected to realign with the higher time frame direction, which remains bearish. As a result, we now have a valid flip zone on the 15-minute chart, represented by this bullish candle. With these confirmations in place, we can reasonably expect price to revisit the flip zone before continuing towards sell-side liquidity. The next step is to wait for price to return to the flip zone and then move down to our entry time frame, the 1-minute chart, to identify a precise short entry. On the 1-minute chart, you can see that price moved higher, and after tapping the flip zone, reversed sharply while forming both a market structure shift and a V-shaped recovery. At the same time, price created a breaker block represented by these 3 bearish candles. Notice the sequence carefully. Price first formed a swing high, then a swing low, followed by a higher high. Immediately afterward, it reversed direction and closed below those bearish candles. This confirms the breaker block and provides another strong layer of confluence for a short position. With these confirmations in place, we can expect price to retrace back into the breaker block before continuing lower towards sell-side liquidity. I am placing my entry at the lowest point of the breaker block, with the stop-loss positioned a few pips above the higher high. For take profit, I am targeting the sell-side liquidity resting below this swing low. Now let's see whether the trade plays out as expected. As you can see, price pushed slightly higher, activated the sell limit order, then moved lower, and eventually reached the take profit target. Let's move on to another real chart example. Here we have the British pound versus the Japanese yen on the 1-hour chart. As you can see, price is already trading lower, indicating that bearish momentum is in control. As a result, our directional bias remains bearish, and we are focused exclusively on identifying short opportunities. If we look closely, we can see an unmitigated 1-hour supply zone sitting above the current price, making it a high probability area for potential short entries. The next step is simply to wait for price to retrace into that supply zone and monitor how it reacts upon arrival. Now, let's continue the chart and see what develops. As you can see, price rallied and tapped directly into the higher time frame supply zone. Everything now aligns with our expectations, so I am going to switch to the 5-minute chart for a closer look at the price action. On the 5-minute chart, after reaching the higher time frame supply area, price reversed and following a reaction from the most recent 5-minute demand zone, immediately flipped it, while leaving behind a clear inefficiency. I am going to mark these bullish candles as my bearish flip zone. This creates a fresh and clean supply area. The next step is to move down to the 1-minute chart and wait for price to revisit the flip zone. On the 1-minute chart, price pushes higher, and after reaching the 5-minute flip zone, reverses sharply while forming both a clear market structure shift and a mitigation block represented by these 3 bullish candles. Notice the sequence carefully. Price forms a swing high, then a swing low, followed by a lower high, and immediately afterward reverses and closes below the swing low. This behavior suggests that price is likely to return to the mitigation block before continuing towards sell-side liquidity. Next, I place my entry at the lowest point of the mitigation block, with the stop loss positioned a few pips above the higher swing high. For take profit, I am targeting the sell-side liquidity resting below this swing low. Now let's play the trade forward and see how it develops. As you can see, the order is triggered after a small drawdown. Price then reverses, moves lower, and eventually reaches the take profit target exactly as anticipated. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the CHoCH Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the CHoCH channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and CHoCH. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.